Hi, I'm Ryan Waterman. I'm a wealth advisor with Farther Finance, and thank you for joining us today to talk about concentrated risk. If you're a tech employee, you typically fall into one of three paths, which we'll discuss today. You may not know which path you're on today, but hopefully by the end of this webinar, you'll realize which path you're on and have clear instructions on how to change your path if that's not the one that's right for you. So let's get into it. I want to start with something that may feel slightly uncomfortable. If most of your income and a large portion of your net worth come from the same company, you're already making one of the biggest financial decisions of your life, whether you realize it or not. Most people don't wake up one day and decide, I want to be highly concentrated. It happens slowly. A job offer, equity grants, refreshers, promotions. Suddenly years go by and the exposure is large, but invisible. And here's the key point. Not deciding is still deciding. Concentration is a default decision, not a neutral state. If this feels familiar, good. That recognition is the point of today's conversation. Most people think concentrated risk is dangerous because prices can move up and down. That's not actually the biggest problem. The real danger is that concentration quietly removes your ability to choose. When liquidity is constrained, decisions don't happen gradually. They get compressed into very short timeframes. IPOs, lockups, secondary offers, tender windows. If you don't have a plan before these moments arrive, you're forced to decide under pressure, emotion, and incomplete information. A plan isn't about predicting outcomes. It's about buying yourself time and choice when those windows appear. Startup equity behaves very differently from public market investments. You can't rebalance when you want, and liquidity is event-driven. Tax outcomes depend on when and how decisions are made, which means small timing differences can permanently change results. Finally, there's information asymmetry. Working inside a company creates optimism and conviction, which is human and understandable, but markets price risk very differently. This doesn't mean your belief is wrong. It means belief alone is not a risk strategy. So here's a mental model most people have never been shown. As a startup employee, you're not making one bet, you're making two. Your income depends on the company's success, and your equity depends on the same outcome. That means downturns don't just affect your portfolio, they affect your job, your bonus, and your future earning power. This isn't judgment. It's simply correlated exposure. Understanding this is not about fear, it's about clarity. So, where are you right now? Everyone here is likely at a different moment. Some of you are pre-IPO with meaningful paper wealth. Some have had secondary or tender opportunities. Some are post-IPO, dealing with lockups, taxes, and sudden concentration. There's no single correct strategy that fits all of these moments. The mistake is copying what a coworker did without understanding why it made sense for them. Your plan has to fit your moment. Most tech employees I speak with have a strong network, both inside their company, with previous companies, friends, people they run into at the gym. And everyone talks. Everyone talks about what they're doing, how much they're making, how much they're risking. But these networks and these groups are highly influential. And that can be both a good and a bad thing. It can surface new investment opportunities, it can unveil new strategies that you might be wanting to take advantage of. But the biggest danger is following those blindly, because you're not in the same position that everyone else is in. You may be on your first startup and your first experience with startup equity, and your coworker may be, successfully have exited two or three companies already in a completely different financial situation. What it comes down to is that you have to evaluate each strategy in the context of your own circumstances, both from a wealth perspective, from a tax perspective, and a cash flow perspective. And none of that can be done without really digging into people's individual financial circumstances, which you're not going to get at the coffee shop. The biggest blocker I see is not math, it's regret. People worrying about being the person who sold too early. Selling can feel like a statement about belief, loyalty, or conviction in the company. Waiting, on the other hand, feels neutral. It feels safe. But waiting is not neutral. Waiting increases your exposure, concentrates your risk, and then often removes future options. People don't freeze because they're greedy. They freeze because they're afraid of future regret. I see the same patterns again and again. I'll just wait one more year. Time feels like safety, but it's often just risk accumulation. People skip secondary opportunities because selling feels disloyal or premature. And IPOs don't create clarity, they create urgency. Suddenly, decisions feel irreversible. And these stories aren't about bad outcomes. They're about being forced into decisions without a framework. So instead of trying to eliminate regret, I encourage people budget it. Ask yourself, how much regret can I tolerate in exchange for flexibility and security? Trying to avoid regret entirely often concentrates it into one massive future moment. A good plan doesn't eliminate emotion, it prevents catastrophic regret. So earlier I mentioned that you're all likely on one of three paths. These are the three paths I see most often. Now, none of these are morally better than the others. And the danger is not which path you choose, it's choosing by accident. As I describe these, notice which one seems to fit your situation the best. So first off, let's do some definitions. Conviction holder. Conviction holders have conviction. Often it's upside conviction about where the company and the stock is going. And as a result, they're the I'm going to hold on for dear life crowd. Risk designers keep upside, but reduce catastrophic outcomes through structure. And frozen optimists hope things work out without rules or preparation. The problem isn't path one or path two. The problem is likely path three without realizing it. So, what do risk designers actually do? Risk designers don't rely on gut feel in high pressure moments. They use rules. They make partial decisions instead of binary ones. They make time-based or event-based triggers. They make plans before liquidity appears. Now, this isn't about market timing. It's about consciously designing your decision framework around your equity. So let's do a 30-second self-check. Take a mental note or screenshot this. If you can't answer these questions confidently, it doesn't mean you're doing something wrong. It means you haven't designed the decision yet. What percentage of your net worth is tied to one company? Take a look at your assets, your currently vested stock, shares you currently hold, as well as your future equity grants. What you want to do is look at what percentage of your total net worth, including your home, vehicles, taxable retirement accounts, what percentage of the absolute total is tied to one single company? If it's over 30%, that is a huge red flag. So this conversation is not about selling. It's not about timing the market. It's not about questioning belief in your company. You can believe deeply and still manage your risk intelligently. So, is your concentration intentional or accidental? If you've never actually modeled the decision around your equity and not just the upside, it's worth a conversation. I offer a short concentration risk review where we focus on clarity, rules, and optionality. This is not about selling anything. It's about making sure your exposure is intentional. If you're near a liquidity window, timing matters. I'll share the link once. The goal isn't to be right. It's to stay free. You don't need to predict the future. You just need to design your choices. Opportunity is the real asset. Thank you.